So, welcome to the Royal Thames. I think most of you have been here before, but if you haven't been here before, this is one of the oldest yacht clubs in the world that's ever continued. It tries to date itself back, I don't know, into the 1600s or something. It's a bit dubious, the history, but it's certainly older than the New York Yacht Club, which is important, and it's older than the Royal Yacht Squadron, which is also important, because the Squadron is the other big posh club in the UK. That's on the Isle of Wight. This is here, obviously. Where are the boats, you're asking? Well, the boats are in the Isle of Wight, but they're also on a reservoir at Queen Mary, which is by Heathrow Airport, which is where there's another dinghy club, which I happen to be the commodore of, and that's where the Royal Thames goes and does its racing, so they do team racing and events there. I am told this evening that the restaurant is not busy, and that anybody who wants to stay and have a meal after the talk, so if you don't fill up on the canapes and wine, you're very welcome to go next door and have a meal there looking over Hyde Park. It's a pretty nice spot to have a meal. I can recommend the food, it's pretty good. The wine list is particularly good and reasonably affordable. It's not a restaurant price, so if you haven't eaten here before, it's quite a treat. Well, here we are. There's an election happening. We weren't expecting that when we set this up, but we thought we would, as ever, we're happy to take lots of questions through the evening. So the more interactive this can be, the more fun it will be. We have got Josh here from Artemis, who runs well, you don't run it, but you work on the...
Oh, yeah.
He doesn't run it.
Well, we can let Julian introduce Josh.
Yeah, we can let Julian introduce Josh. And we have Nick, who you know, obviously, who's our investment director, and me, and we will try and answer questions on anything that you want to look. Josh is going to give you a little bit of a roundup of what's been going on in the market and how they've navigated their fund. I think it is our best performing fund. Correct. That's good. So you've got the leaders of the pack here, and then we thought we might do a little bit of discussion about active versus passive, which is on everybody's lips at the moment. Should I just put all my money in an index fund? Why bother with spending an extra 50 basis points a year to have active management? And we'll have a little bit of Josh versus Nick on that as to what's going on.
We're on the same team.
Yeah, we're all on the same team, but that's good. But please do have questions. We can have questions as we go along, but we'll have some time for questions at the end. Are we just having drinks as we go along, Edna? Is that the plan?
I'm sorry?
We're just having drinks as we go along?
Yes, drinks and canapes. Food is coming in 5 minutes.
And I should do a quick introduction of all the Tideway people who are in the room. So we've got Edna here, who runs our marketing team. We have Ben, stalwart wealth manager. Sue, stalwart wealth manager. James Saddington over there in the white shirt, checks. He's our compliance officer, making sure we all behave ourselves this evening. Seymour in the blue shirt, new blue shirt. who gets involved in our ESG principles and also is doing new business development with us. Will, who, for any of you know, Will started with us in client services. When was that, Will?
2016.
2016. He took us quite a bit of persuading to get him to do the exams, but he finally did the exams, passed the exams, and now has moved into wealth management, is making a fantastic job of being a wealth management. And Costa, who works with Nick, who also surprised me completely. I would have lost my shirt had I bet. But Costa passed the chartered analyst exams first time round, and that is not easy. So he's a lot cleverer than he looks. That's all I can say. That's all I'm going to say. And with that, I'm going to hand over. Well, I'll hand over to Julian first. He's going to introduce Josh.
Yeah, I just quickly introduce.
Big build-up.
Yeah, totally. Didn't come prepared. Lovely to see you all this evening. Josh and I both work for a company called Artemis, and we're a fund management group, and we run money on behalf of, we speak to Nick, who picks funds that we run. We're a £25 billion asset manager, effectively, and within that we've got 29 strategies and one of which is Global Income, which we'll be talking a little bit about today, and that fund is in many of your portfolios if you've got money with Tideway. So effectively what we're trying to do is pick both bonds and equities that outperform the average in the market over the long term. And I'm pleased to say actually that this year has been one of our most successful years. 27 out of the 29 funds that we've got at Artemis are outperforming the benchmark, which is quite significant. The Global Income Fund is one of our best performing funds this year. It's already in double digits in terms of its return profile, which is way ahead of the peer group and way ahead of the average or the benchmark. So when we come on to talk a little bit about active versus passive, it will be quite interesting to compare this year's returns with the last few years. Josh joined Artemis quite a few years ago now to work alongside several of our fund managers at Artemis, one of which is the Global Income Fund, but he also works with one of our longest standing funds at Artemis, which is the Artemis Income Fund. That's also our largest fund with just shy of 6 billion in assets in that fund alone. Global Income is about 1.5 billion in assets, and we run money on behalf of many different types of clients around the country and also across Europe. In terms of what we're covering today, we're going to talk a little bit about global markets, but we're open to have questions. If you've got any questions about anything complicated, please ask Josh. Anything else, feel free to ask me a question. But with that, I'll hand you over to Josh who'll give you a bit of an overview in terms of what's going on in global markets.
Thanks, Julian. Yeah, being called leader of the pack, that's a bit of a kiss of death, isn't it? Never mind. Thanks, Paul. Good to see you. I think I saw some of you last year. Fair bit's happened, I think, in the last 12 months. I think it's fair to say. When I was last here, Credit Suisse had just collapsed, as had Silicon Valley Bank in the US. And I'm sure many of us can remember 2008. It's quite scary when banks collapse. Banks are very important cogs in the global economy, so any fears of sort of contagion or bank collapse spreading is quite concerning. But actually, since then, stocks have been pretty strong. The global economy has been very strong. The US has been incredibly strong. It was meant to fall into recession in 2022. It's added about 8 million jobs since then, so all the strategists were wrong. The investors were wrong as well. Everybody thought there was going to be a recession in the US. And actually, very importantly, inflation has moderated as well. Maybe it's started to tick up again a little bit in recent times, but we've sort of come down from those sort of high single-digit peaks down to sort of 2, 3, 4%. Last year, and actually sort of the start of this year as well, in terms of what's been driving returns, it's all been about the Magnificent Seven, and I'm sure you've heard of these companies. It's effectively the 7 biggest companies that have ever existed, really. They're sort of, as big as whole stock markets. So Apple and Microsoft, they're each about as big as the entire FTSE 100. So the scale of these companies is really quite incredible, and they are at the forefront in the market's eyes of the sort of the AI revolution. So there's been lots of talk about artificial intelligence over the last 6 to 12 months in particular, how it's going to change all of our lives. And these companies are seen to be the winners from artificial intelligence. So they really have dominated the market in recent times. As I said, inflation has been moderating broadly, and in November last year, we got the clearest sign yet that the Federal Reserve was thinking about cutting interest rates and not raising them. So that sparked a really, really strong rally across bonds, across equities, across basically everything. Because people were now thinking about, okay, interest rates are going to come down instead of go up, and that is normally pretty supportive for all asset classes. As I said, though, there's been a bit of a sort of a kink in the road, because in the last 2 to 3 months, so into 2024, inflation has started to edge up again. And that's been a bit of an issue for people who are expecting lots of interest rate cuts. So the Federal Reserve, the US central bank, the most important central bank bar none, has now started to use the phrase higher for longer again, effectively meaning that interest rates will be higher for longer. So I'll talk a little bit about where I think we go from here in a few minutes, but maybe just to touch on the Global Income Fund as introduced by Julian. So broadly speaking, we like cheap companies that are making lots of free cash flow. So cash that is available after you've paid everybody, you've paid your interest, you've paid your employees, etc., etc. So it's companies that are generating healthy profits. We also like dividends as well because we're an income fund. So we like the parts of the market where we can find good dividends. These magnificent 7 companies that I mentioned, they're very expensive companies and the dividends that they pay are quite skinny. So we don't really look to invest in them. I'm sure you will have exposure to them elsewhere in your portfolios, so we'll leave that to somebody else. But having said that, it's been a very good 12 months for the fund. And what's maybe the most pleasing is that we've managed to generate those returns in a very different way to not just the benchmark, so the market that we compare to, but also our peers. Defence has been a really strong performer for us. Sadly, defence companies are faced with their sort of biggest structural tailwinds and the best environment since the Cold War. We met with BAE Systems a few weeks ago. They think they are faced with a $250 billion market opportunity over the next 10 years. The world that we live in is very different now. I'll come on to that in a few minutes. So we have a big position in defence in the portfolio. That's been very good for us. Also banks, which is quite interesting, I think, given 2 banks collapsed just before I was last here. And banks have actually been one of our best performers over the last 12 months, particularly in Europe. The basic story is interest rates have gone from nothing to something, and when interest rates are nothing, it's pretty hard to make a profit as a bank. But when interest rates are positive, banks can obviously make a lot more money. So they've been generating lots more profits and they've been returning lots of them to shareholders. Also, industrials, some of the scale of the fiscal stimulus, so the spending on things like manufacturing, you might have heard of the Inflation Reduction Act in the US, has been absolutely enormous. So CRH, which you might have heard of, is a company that recently relisted from the UK to the US. They are speaking of a golden age of construction like they've never seen in the US. So that's been another area that's driven some really good returns for us. And finally, Japan. Japan has sort of come and gone a lot over the years, but we do think something genuinely different is happening in Japan at the moment. Firstly, we can say it's probably one of the only places where inflation has been beneficial. There's been deflation in Japan, which is normally pretty damaging for an economy, and inflation has got the economy going a bit again, which is good. And actually, more importantly, corporate governance reforms. So the Japanese regulator and the Japanese stock exchange saying to companies, you need to disclose more in English, you need to be more friendly to investors, and you need to realise more value for your shareholders. This has been talked about for many years, possibly even decades, but we're seeing real evidence that it's happening. So those are some of the areas that have performed particularly well for us. And as I said, I think what's most pleasing is that we've done that in a very different way to the market. So where are we going? The phrase regime change is one that I used when I was last here, and I will just dig into that a little bit. So if we think about 2008, 2020, we had very low interest rates, we didn't have much inflation, we had peace, we had global peace, and we had globalization. So we had China exporting everything, we had very sort of finely tuned supply chains where bits of goods would be made in lots of different parts of the world. Everything was very efficient and everybody was very happy and the world was good, I think you'll agree. We could all afford massive mortgages, you could borrow money for free. It's a pretty good world, I think you'll agree. But we would argue that the world is very different now. Regrettably, peace has given way to war. The global order is fragmenting. Supply chains are a bit more protectionist now. What do we mean by that? Well, maybe you don't want to buy your chips from China. Maybe you want to build a factory in Texas, or you want to build a factory in Mexico where a more friendly nation might be. And that's all very, very inefficient. And kind of the upshot of that, we think, is that interest rates are going to be higher for longer and inflation is going to be higher for longer as well. Once the inflation cat is out of the bag, as we've seen a few times in history, it takes a long time to go back in it. And the point of that, or the crux of that, we think, is that the companies you invest in that different environment have to be quite different. A company like Microsoft, that can quite easily straddle both environments. We're not trying to say that Microsoft will be irrelevant in the 2020s, but maybe instead of investing in technology companies, it might be about banks, where there's higher interest rates. Maybe instead of the US, it might be about Japan. Maybe instead of intangible assets, it might be about commodities, from fluff to stuff, is a phrase that we use. So we do think it's a very different world that we're moving into, and we'd like to think that is part of the reason why the portfolio has done pretty well over the last 10 months. Very happy to take questions now, but I think I'll stop there because I've talked for far too long. And
Perfect, Josh. Thank you. Fluff to stuff.
That's not. I can't. That's Jakob, Jack Jakob, who actually runs that fund. That's his phrase. So I can't claim that, unfortunately.
So, has anybody got any specific questions that they'd like to ask about the fund at this point, at this juncture?
So just what other sectors apart from US construction, banks, does the fund?
So we like banks, we like insurance because again, they've de-risked insurance companies have de-risked massively over the last 10 years. Higher interest rates are pretty positive for insurance. We like industrial companies more generally, and actually a big theme is kind of tangible assets. So let's take some. Yeah, so not just commodities, but let's take something like Komatsu in Japan,
Right.
which manufactures diggers effectively and excavation equipment for the mining industry. I think that's a pretty good place to hide at the moment. What else do we like? Nuclear energy is actually a decent theme in the portfolio. Again, that's an area that most investors are a bit reticent to hold, but we would argue if we've got any shot at net zero, nuclear has to play a role. We just don't really see how else. There's no other sort of guaranteed carbon-free.
So is that Rolls-Royce?
So no, we don't hold Rolls-Royce. We hold Cameco, which is they produce uranium and they also build nuclear reactors after an acquisition they did recently. And Fluor is another company as well. They build nuclear power plants, and actually Mitsubishi Heavy Industries, really getting into the weeds now, that's a Japanese company that they are involved in defence, and they have a near monopoly on nuclear power in Japan as well. Japan are switching all their nuclear reactors back on that have been turned off for about 10 years after the tsunami in, I think it was 2011. So that's pretty good for Mitsubishi Heavy. So we like generally speaking, we like cheap stocks that have been unloved for a long time that produce tangible assets. Yeah, I think that's the kind of short version.
Can you give an idea roughly of the valuation of the overall portfolio compared to the wider market?
Well, you're stepping ahead of yourself.
I want to know the answer.
So I think now is a good time.
Okay.
So
I'll hold that one then.
Yeah, just a second. So we do get asked, and Ben and Sue and Will back me up on this. It's the most common question asked by clients over the last 6 or 9 months is, why don't we bother with you guys? Why don't I just go to Vanguard? Why don't I just stick it all in the index? So if we have a little presentation on that, which we can almost go through line by.
I don't know this presentation.
Line by line. So I think I think this fund is a particularly good fund so trust me on this.
Yeah.
So this is a particularly good fund to do the exercise. But what would be quite good would be to just work through some of the parameters and compare the index issues, if you like, the index parameters to the fund parameters. So you raised valuation. So if we were to look at the index, for example, what is the average on a PE basis? What is the average valuation of the index?
So the index is about 23 times, and we are about.
And when we refer to the index, we're talking about the world index. I know it doesn't make much difference.
So that's the world. So that's developed markets plus emerging markets. So that's everything.
So and just because of some of the things that Josh touched on in that talk about the size of these funds. So all these indices are market weighted. So they are invested in proportion to the value of the companies. So right now, it doesn't really make any difference whether you invest in the world or you invest in the S&P 500. It's a snip difference between what those two indices look like.
Yeah.
So when we refer now to the index for the rest of this conversation, we are really talking about the world index / the S&P 500 index, and there's not much difference between the two. So valuation on the index is about 23 times?
It's about 23, yeah.
And on your fund?
13.
13. Wow. So that's a big difference. So we say price matters. I think you'd probably agree with that.
Yeah.
So obviously if your business is worth 23 times, You've got further to fall if your business plan goes wrong. So that's one reason why price matters. So it's higher risk. And also in terms of pushing the valuation from 23 to, or maintaining that valuation, you've got to keep investors very interested in your stock, because if you go out of, you could, for example, double your profits, but the share price could stay the same if you went from 23 to 11 as a market valuation. So the price that we pay for companies is really important. So there's a big difference there. So it's about half price, basically.
Yeah, it's about half price, yeah.
So we're roughly spending...
So is that slightly more difficult for you when interest rates don't fall quickly? Because the value players tend to...
Why do you think that?
Well, tech stocks have always had this thing where if they compare their enormous earnings growth,
They present value them.
MPVs,
Yes.
which I never
Understand.
put that over there. But it seems that the value players come good when interest rates fall, and some of the traditional value players then exhibit good growth against lower interest rates.
So what we have observed is that these massive technology companies, they like interest rates to be very low because, sorry, again, we're getting into the weeds here. They are effectively predicted to grow their earnings, not perpetually, but for a long time. And if the discount rate, you discount that by is naught, then it's worth more, effectively.
Growth, yeah.
So if you have a company that's meant to grow its earnings long into the future, if you even slightly adjust that rate, then the value of those earnings falls quite a lot. So what we've actually found is that the value stocks that we invest in are actually a bit better at dealing with higher interest rates because they're generating more money today, effectively. And when you kind of compare that to a bond, a risk-free bond, where you can get sort of 4.5%, 5%, we found that to be a pretty attractive place to be. And I guess the sort of the crude version of when you talk about the market being on 23 times, us on 13. For us, it's kind of heads you win and tails you don't lose as much. That's sort of the crude version of it. So you kind of get that support from investing in cheaper companies. But what I would say is that if we look at kind of the earnings growth of the portfolio, so how quickly is the portfolio growing profits, it's actually quite similar to that of the index. So we think that's pretty good. You're getting the same
On a lower rate.
for less. Exactly.
So how long do you hold these things for?
It varies massively. Sometimes it will be 6 months, sometimes it will be 3 or 4 years. It kind of depends on the company, the kind of the riskier companies that you need to invest in, and if the share price goes up, you then need to get rid of them because the share price could go down again quite easily. But then some of our bigger positions that we maybe have a little bit more conviction in. So some of the defence companies, we've held them for 3 or 4 years, for example.
Right, yeah.
So the short answer is it varies a lot.
Right.
I suppose it's worth mentioning the fund's got a yield on it as well. So even if the market remains constant, it doesn't move, say 0% throughout the whole year, which is very unlikely, you still earn an income from the dividends paid out by the companies with this particular product.
And how much growth do you have in those dividends across
So
the
the
fund?
dividend has grown 8% per year since inception on average.
Good.
And that's since 2010. So if you think it's a 4% dividend growing at 8%, that's about 12% a year, which is pretty good, we think.
So then the next thing perhaps would be geographical allocation. So what have we got on the index at the moment?
So on the All Countries World Index, it's around 64%. Tell me if you disagree.
No, that's right. And on the World Index, which is just developed markets, the US is, it's as good as makes no difference, 3/4. So by investing in the world, you are effectively just investing in the US, which has been a good thing to do for the last 10 years, don't get me wrong. But as I said, we're in a different world now. You do kind of get mean reversion in the long term, so the US probably won't stay as big as it is forever.
Where are we with Japan and the UK on those?
So the UK...
On the index?
So the UK has fallen from about 10 in 2010 to about 3.5, 4 today. Japan has gone from about 9 or 10 to about 5 or 6 maybe.
And that's the second largest market.
Yeah, exactly. And
Is it? I didn't know that.
And again, the US is full of technology companies, and the weight of technology, if you include technology and stuff like Amazon and Tesla, which are not technically in the technology sector, but they're tech companies, let's be honest. Technology is about 35-40% of the global market.
We'll argue about that in a minute.
Well, we certainly will. So that I think just sort of moving on to the active.
So on your fund,
Yeah.
so we've got 75% in the US, 5% in Japan, 4% in the UK.
So-
what have we got on?
So we've got about 25 in the US, 35 in Europe, 20 in Japan, 5 in the UK, and then we've got some Brazil, we've got a little bit in South Korea, and then a few other bits.
So
which I
that's a
can't
massive
remember off the top.
difference.
Yeah,
right there.
exactly.
Yeah.
So we would argue that is truly global.
Yeah.
Where
That's really interesting.
yeah, exactly. So and we sorry, go on.
I was going to say, what's your view? Because we're going into an election, and indices are very positive at the moment. What's your view, for example, with the USA after the election?
Of the US.
Of the US?
So it's a really interesting point, actually. If we compare the UK election,
I thought
to
we
the
could
US
avoid
election-
elections.
No, it's inevitable.
That's where we got into them before. Never mind.
I mean, in the UK, you've basically got two fairly set. Well, A, we know who's going to win. Let's be honest, and B, you've got two sort of fairly central figures. Kind of, they've been pushed into the middle a bit. But in the US, you've kind of got socialism and the far right. For the biggest economy in the world, that is enormously consequential for everything.
Yeah.
Well, I mean, it kind of our view. Well, I say our view. My view is that if Trump doesn't go to prison, he's probably going to win,
Yeah.
which kind of seems completely mad. But I just don't see. You know, inflation's ticking back up. There are a lot of people who sort of, take what he says as gospel, and he's managed to sort of spin a criminal trial positively. It's just, it's incredible. So I personally think if he avoids prison, he will win. But no, it's really difficult to say what's going to happen. But what I would say is there's a lot. I think 40% of the world's population are voting this year. We definitely have to be mindful that there are some pretty consequential elections.
Let's come back to politics in a.
So I was just sort of like referring to the fact that pre-elections is always very positive, and then economies tend to change slightly after elections. That's really where I was coming from.
Yeah.
And I'm just as a follow-up on that, if I may.
Sure.
What do you make about what's the view with regard to countries like China dumping debt and the debt situation in the USA? I mean, I'm quite pleased with the fact you said you're only actually investing in 25% in the US economy.
Yeah, I mean, the debt is scary everywhere, really. I mean, the US national debt is going up by $1 trillion every 100 days at the moment, which is a lot. And that's part of why we like tangible assets. We hold a couple of gold producers in the portfolio. Gold's at all-time highs, and that's effectively, that's A, China stockpiling, and B, the kind of the fancy term we use is de-dollarization, but it effectively means, when people are kind of losing confidence in the US's ability to pay back its debt, you hold a safe haven, which is gold. I mean, there's an enormous amount of debt in the world. At some point, central banks and governments will need to move to try and reduce it, but I think that's another kind of feature of this regime change we discussed. So you had period of austerity in the 2010s, and now we need to pay for the energy transition, we need to pay for defence, we need to pay for, cost of living crises, we need to pay for infrastructure in a lot of countries. There's a lot of really expensive stuff that doesn't win many votes, unfortunately. So, it's going to be whoever comes in the UK next, in the US, it's a really tough situation, I think, because kind of the fiscal hands are a bit tied everywhere. I don't know if that answers your question.
No, I was just interested in your viewpoint. Thank you.
So we've dealt with price.
Yeah.
We've dealt with geographic location. So the third one is to look at concentration risk, and this comes now back to the market cap. So if you're in the index, what have we got in the first 10 stocks?
25%.
It's about 25%, yeah.
So we got, if you buy the index, you've got 25% of your investment is in 10 stocks.
Yeah. And I should say...
Can we name them?
Well, there's
Come
all...
on, guys.
Should we have a go?
You can
Absolutely
do it.
not.
What I would say is that...
I'll give you the 7, right?
If you there's 7 plus some others. But if you look at the index in 2010, there were about 11 or 12% in the top 10 companies. So that concentration has increased massively.
So that's a factor of these big companies getting so huge.
Exactly.
If you take the first 11, it's gone from 11% up to 25%.
Exactly.
Roughly.
Exactly.
And the most amount you've got in any one stock?
We have about 4 to 4.5% of the portfolio.
Whereas Microsoft today is...
Microsoft would probably be about 5 of the global benchmark. But if you look at that kind of on a market value basis, I mean, Microsoft is just an absolutely sort of $3.3 trillion, which is, as I said, it's about the same size as the FTSE 100. So the 100 biggest companies in the UK is one company in the US.
And the scary one for me, which obviously had its earnings today and did really well, is Nvidia, because that is
I was
now,
hoping nobody would mention.
that's
Give it a
now
go.
2.5. Well, there's quite an interesting one.
Yeah.
So there's 2.5 trillion market cap just in Nvidia, which is it was nowhere two years ago.
The shares have gone up 3 or 4-fold in a couple of years, effectively. And that is kind of right at the forefront of it's basically seen as the facilitator of artificial intelligence everywhere, and it's kind of got a near monopoly on the software, the ecosystem, and I think it's got 83% market share in the chips at the moment. I mean, it is an absolutely amazing company, but it is priced to dominate.
Yes, and so it had really blowout earnings overnight, and it popped, I think it was up 10%.
So it put on Shell's market value overnight, the entire company.
But it was 10%?
Yeah, it's 10%.
Is it still up 10%?
Yeah, it was up about 12 earlier, I think.
Yeah. So another company that we're all familiar with is AJ Bell.
Yeah.
So today there was a bid for Hargreaves Lansdown, which is quite interesting, coming from private equity.
Yeah. It's
And
consulting
that
with
whole
private equity.
sector popped, and I think we got 14% on AJ Bell. I'm guessing you don't own AJ Bell in the portfolio.
We don't, no, we don't. Or
But
Hargreaves.
if you're with us, you'll have Unicorn Income.
Unicorn UK Income.
Unicorn UK, which does own AJ Bell in the portfolio. So 14% on AJ Bell, and it's gone probably from 15 PE to 16 PE or something like that, or probably even less than that, actually, I'm guessing. Whereas Nvidia is on 70.
And if
and
you
it's
look
gone
at next
from-
year's earnings, it's about 50. So yeah, it's
Yeah.
expensive.
Yeah.
It's
So
expensive.
there is a long way down when, one of the things that we're always worried about is big losses and trying to avoid big losses, because we know that for most of our clients, this is it. They're not going to save more money in the future. It's what we call irreplaceable capital. And so if you're investing at 70 PE and for whatever reason Nvidia gets it wrong, there's an awful long way down before they get to become a value stock. that these
Agreed.
guys will buy.
And actually, if you look at Cisco in 1999 and Nvidia today, the chart looks very similar until a certain
And
point.
what happens?
Well, exactly.
Cisco collapsed.
Yeah.
The difference now is that you've got massive bets on 7 to 10 companies at the same time that government debt is up here.
Yeah, exactly.
And therefore, you get a problem with government debt not being funded.
Yeah.
One or two of these fall over.
No, you're right. And it's the debt markets, it's the bond markets. They're the boss at the end of the day. I mean, we saw with Liz Truss. If you're fiscally irresponsible, the bond markets will shut you down very quickly. Because future interest rates went up to whatever it was. So, and I actually think that's why the UK election is relatively inconsequential, because both parties have seen very recently that you cannot be fiscally irresponsible or you will get punished, and everyone in the country will get punished thereafter. It's interesting.
So we've done price, geographic, concentration risk. Is there anything else that we should cover when you do this pitch?
No, so sectors as well.
Who did this? Who said sector?
General
Sectors is a good one, but sectors is deceptive, right? So
very deceptive.
here we go. Tesla, is it a tech stock or is it a car company?
Well, it's more valuable than every other car company put together, I think.
Oh, it was.
It was, yeah.
I'm not sure it is anymore, because Toyota has come up a lot.
Yeah, no, you're right. It's interesting. I think you kind of have the fans that think it's going to revolutionise robotics, and then you have the sort of the bears who just think it's just a car company that's way overvalued and doesn't make any money. So I'm not sure which camp I sit in, to be honest. It's a very expensive stock. It doesn't pay a dividend, so we would never invest in it in this fund. That's my kind of cop-out excuse from discussing it at any great length.
And Amazon, you might say is it a tech stock or is it a...
so the fact that Amazon Web Services generates nearly all of the profits, I think means it's a tech stock.
Yeah.
But it's a consumer stock effectively.
Yeah.
But it's part of the Magnificent Seven, and I would say they're tech. So again, we can have a long debate about that.
Yeah.
But
And Netflix.
that's a tech stock. It's got to be. It's got to be.
What about other defensive stocks in sort of consumable type stuff like Coca-Cola?
How much have you got in defence, Alan?
In defence, we've got about 10%.
And what would the world index have?
Much, 1 or 2 probably. I mean, very little. Well, defence sits in industrial, so it's a difficult one. But yeah, we've got a massive overweight in defence. So we own BAE Systems, we own Mitsubishi Heavy Industries, we own a Korean company called Hanwha Aerospace, and we own Rheinmetall in Germany. We don't own the American ones because they're very expensive. You can see, but sorry.
As I say, assume your competitor would do the same, because it doesn't seem to be...
Well, no, interestingly, so if you hold BAE, but interestingly, defence it's a kind of a bit of a taboo area.
Is that because it's sustainability stuff?
Well, yeah, and yes, I think so. And I would say that kind of defence and, defending our values, this is my view, but not Artemis' view, disclaimer here, but I think that's kind of quite important in everything else in a sort of functional society working. So in my view, I think defence and ESG are actually a bit closer together than people think. But no, you're right. I think it's a bit of a sort of sustainability issue. I think it's because they have been really poor investments for a very long time. But now, as I said, the kind of the structural tailwinds are so strong. And I think Rheinmetall was saying if they worked 24 hours a day, 365, they'd probably, they wouldn't miss a shift for 5, 6, 7 years. I mean, they're that busy. Because we've had cognitive dissonance about defence for so long that nobody's got stockpiles. What we have got, we've given to Ukraine, and we're now sort of realising that wider war is not a completely ridiculous thought anymore. So there's just this enormous kind of structural tailwind to defence.
So why don't you own Rolls-Royce?
Why don't we?
Yeah.
It's a good question, to be honest. Maybe it's one we should look. Well, of course, it's one we should have looked at earlier because the shares are up 250% in a year.
Yeah, you missed
it. We have potentially missed it. So I think it's quite interesting that whole sort of aerospace value chain is quite interesting. If you look at the engine manufacturers, if you look at something like Safran in France that makes a lot of the components. I mean, Airbus are going to be busy for a very long time now because I'm not sure people are going to be buying Boeing planes anytime soon. But Rolls is an interesting one. I mean, if you look at the shares over 5 years, they're flat to a little bit up because it has been rubbish for a long time. And, there have been several CEOs there saying, we're going to do this, we're going to do that. And it hasn't really worked. So I'd say it's probably not one we've looked at in great detail, but it's definitely, it's definitely on the radar. And if the shares were to go down 20-30% again, then we might look to buy it.
It is one of the main UK's defence manufacturers, isn't it?
Yeah. So that and BAE, and they're two pretty big companies now actually because they've done quite well recently. But no, we missed that boat. Happy to admit that one.
But we own it across the business though. We're one of the biggest shareholders of Rolls-Royce. We do hold it in other funds as well, so we know the management there really well. And have done a lot of work with them.
Just not in the global income.
Just not in this particular product.
And just to reassure you that you haven't missed out completely. One of their competitor funds. There you go. Had a nice big position very early doors. So
which one is that?
That was with Schroders.
With Schroders.
Yeah.
Global recovery.
Yeah.
Can't mention
that
here.
That has been a recovery.
Yes. Very good fund.
Yeah. So we have got that. So we've done sectors, value, geography, concentration. That's probably it, isn't it?
Performance.
There we go. We could say the best or last.
Says a salesman.
Yes. There you go, Julian. Yeah, exactly.
What's left, Josh? Basically, we get a lot of questions. Have people missed the boat, given the fund performance is so strong? And it's one we come back on time and time again, but...
Well, look, the simple answer is no, we don't think so. The fund has a nice dividend yield, it's growing that dividend, and it trades on a cheaper valuation to the market. The latest earnings season, so when our companies have reported, the results have been very strong. We've got good reason to think that the companies we invest in and the companies we will invest in the future, in the sort of thematics that we like, will be in the industries that are in favour in this new world, if that makes sense. So, look, the fund had a pretty tough time in this low interest rate environment when sort of technology was the only game in town. We now think that we've kind of got tailwinds from sort of the global macroeconomic environment, if you like. So inflation, higher interest rates, fragmented global order, etc., etc. So we actually feel probably more confident about performance going forward than we have for a while. It's done very well this year.
You mean relative or absolute?
Both, maybe. I'd say both. So no, we feel good. You know, it's a different portfolio. It's not different for the hell of it. It's different because we think those are the right sectors to invest in. And as I said, when it trades on half the valuation of the market, you've just got that support as well. There's a lot less further to fall. You know, technology companies are very expensive. The market in general is very expensive. It's very difficult to know when that might turn, but history tells us it probably will do at some stage. Could be 1, 3, 5, 10 years, who knows? But I think we're in a pretty good position there.
For any of you who do have access to or use performance charts, and there's some quite good sites around TrustNet and on the FT and various things you can plot things. One date that's worth looking at is November 2021.
Actually read.
Was it November 2020?
Thank you.
It was the point where we had
The vaccine, yeah.
Yeah, we had the vaccine, we had Biden.
Yeah.
Because I was offshore at the time, so I was out of email contact for like 3 days. And when we popped up at the whatever those islands are called, off Africa, we had a new president. The vaccine was coming out, blah 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 blah. And actually, if you take a lot of the charts back to that date, you will see very different winners versus if you go back to
really good point.
So I think your fund, recovery funds, all of our value managers, basically since that point, November 2021, have been doing pretty well against the index.
Yeah.
Yeah. Prior to that, not so good, but
Yeah.
up from that point, it looks good.
Market cap?
Market cap. Well, yeah, no, that's interesting.
That's a good one,
No,
actually.
it is
That's
a good one.
On fire tonight, aren't
Oh, yeah. Glad somebody came here.
6 years of nothing, and then
So, before you start on market cap, because Ben has brought it up, that is such a huge issue. Right? I'm going to maybe steal your thunder, but I'll give my answer before you give your. So obviously, if you're Microsoft to double your value, you're asking every person on the planet who has. I did this maths myself, right? So everybody on the planet who's got an income of more than $30,000 a year is already spending X with Microsoft, and we'd have to spend 2X with Microsoft in order for them to double. And it's getting quite a large number.
Yeah.
And so, big companies, to keep up those percentage compound growth rates, it just gets harder and harder and harder. So market cap is really key, and I'll now let you speak.
So the kind of market
What
cap,
is sorry? Well, we should just have the facts, right? So what is the average market cap in the world index?
several hundred billion, because it's so skewed by these massive companies at one end.
Yeah.
So let's say let's weighted average market cap probably 400 billion. That's my educated guess.
Gosh.
Our fund is it's enormous, and if you sort of did it without.
So when you just to put that in context, at the bottom of the FTSE 100, companies are worth 2 billion, right?
Yeah.
So these wouldn't. Now when we go out for smaller companies managers, they're basically looking 5 billion and upwards. So our FTSE 100 companies don't even make it into global small cap.
Yeah. So let's contextualize this. So the average market capitalization of weighted average, in the global market is about 1.7 Shell. So that's one of the biggest companies in the UK. So the scale of these companies is just absolutely massive. Our fund, we don't think we're a small cap fund at all, but relatively it looks quite a lot smaller. So let's say we might be, 70 or 80 billion, which is still very, very big by UK standards, but by global standards, that's not very big at all.
Quarter of
exactly.
the index weighting.
But no, it just kind of reinforces this point that the global market has become so skewed to these, 7, 8, 9, 10 enormous companies that are 25% of the index and not control, but influence the
And Nick,
entire
you've
market
looked at
so much.
some of the stuff about big companies in the past and where they are a decade later. You had some research on it.
Well, some smarter people did some research, and I read it. But essentially, the crux of it is, at the end of each decade, the largest companies, at the end of 2010s, 2000s, 1990s, there's been no further than three holdovers each time. So
you're talking about Cisco's and the IBM.
yeah, exactly. And so when combined with exceptionally large concentration risk at the top of
GE, IBM.
Wow.
So
It's frightening.
yeah, so when combined with this concentration risk and $1 in every $2 of people's money going into passives, for us just to throw all our money in there blindly, for me, despite good performance, that's not a riskless proposition. So I think you're going to get some natural turnover there. Winners don't stay winners forever.
No.
And I think obviously that's why we allocate money elsewhere. Despite sometimes that being a relatively tough proposition.
So just to summarise, when you look at the index, what you should do is lift the bonnet and see it just as another fund, right? And as a fund, it's got this high concentration, it's all US, it's very expensive, it's completely focused on the tech sector.
Got a lot more stocks.
It's got a lot more stocks. It is got a lot more stocks, but further down the chain, there are tiny amounts in it. So what you're investing in is actually quite a concentrated fund.
Yeah, sure.
And when you leave that behind and come to an active manager, and I think this fund is a classic example of what an active manager can do. This is not a closet tracker, right? So there are funds out there who just track the index and charges all 75 basis points for the privilege when we could do it at 0.1. But this is not a closet tracker. This is something that's doing something completely different on all the scales that we can measure. Is that fair to say?
Hopefully, yeah. No, thank you for the support for everyone. We'll keep trying our best.
And we'll sell that to the FT for the weekend. Good. Right. Any other questions? Gosh.
Can I ask one about the Fed?
Yeah.
They aim for 2%.
Inflation.
Yeah. Right?
Yeah.
Okay. Europe, that lot, they aim for 2%. We aim for 2%.
Yeah.
And every time anybody makes a statement, they just copy whatever the Fed say. There's a growing bunch of people that are saying, why 2% and who the heck started that? It's a bit like 10,000 steps. I have to walk 10,000 steps.
No, you're right.
Who gave you that? Who came up with 10,000 steps?
10,000 hours.
There's no sign.
I it to my dog. It went around the house. It was great. But it's just rubbish. 2% could be completely inappropriate.
It's an arbitrary number. There's no scientific base to it at all. It just sounds good. But you're right. I mean, whether the Fed formally accept that 2% is no longer the target or not, it's pretty clear to us that when you've got wage inflation of 6%, 2%, the numbers, it just doesn't work. It just doesn't work. So no, maybe. So we actually spoke to a CEO a couple of years ago now, actually, and they were thinking sort of, in terms of 3 and 3. So maybe you have 3% inflation, 3% rates going forward. And actually, that's normal. Like 2% inflation and 0% rates is completely abnormal. And we've seen the problems that's caused, frankly. So no, you're right, 2% is a completely arbitrary number. And actually, it's interestingly, looks like 2% is more achievable in Europe and the UK, but in the US, it's way off because the economy is just too strong.
I just wonder if that ever starts to change. I think it would be quite good.
I mean, it would probably be healthy, wasn't it? Because I think the 2% number was in response to the global economy nearly crashing in 2008 and then just endless money being pumped into the system to try and get economic growth going, where you didn't really have to worry about inflation because it just wasn't really a consideration. So no, you're right. Maybe in a new world we need new targets, and central bankers are probably thinking, 2% is a bit ambitious, really.
Yeah. Okay.
I've just got a question. This whole issue of relisting from the UK to the US. During your presentation, you mentioned a company. Actually, I can't remember what it was.
CRH.
CRH.
Yeah.
I think is it Dark Trace is also.
So that's been bought by PE. So that's not relisting. That's just been bought by a US.
But this whole idea now that to get the liquidity, you need to go to the US. It's sucking the companies out of the UK. stock exchange, which seems to me it's going to reinforce this whole issue of concentration in the US over time.
It does. I mean, it does. So what would I say? So when a company, it's rumoured that the company is going to list in the US and the share price goes up 40% like it's been bid for, that to me is a sign that the UK is really undervalued, and it just seems a bit silly when you've got exactly the same company and it might relist in the US, so it should trade on, 40% higher multiple. That seems a bit odd. I think there will be more companies. So Flutter has gone recently, CRH, I think Ferguson is another one. But yeah, it's an issue for the London Stock Exchange, and I think the announcement of the British ISA, I don't think it's going to do anything really, but I think it's a signal that the government recognises that it's a big problem, and I think the man on the street doesn't recognise that a really vibrant stock market is very important for an economy. I mean, the amount of wealth that the US stock market creates for people in America is enormous, and actually the world as well is enormous. So yeah, it's a concern, and frankly, the UK has been a bit better recently, but if the UK remains undervalued versus the US and the world, the companies will just be picked off. If you were sat in America and you could buy a good company with 4 days cash flow, why wouldn't you do it?
Yeah.
You just would. So no, I think it's an issue, and hopefully the next government, whoever that is, they kind of recognise that we need to think about this carefully.
It was shocking when you said, is it 4% now, the global equity?
The UK, yes, 3.5%, 4%.
Yeah, it's quite interesting. Actually, I'm just putting up a chart here because we had a broker send us something recently, and it was talking about the pension allocations to their domestic stock exchanges.
Yeah.
So Australia is an example. So 40% of their pension has to go into Australian listed companies. And it's the same for Italy, 41% in Italy. Japan is 50%. France, 26%. The US is 64%. The UK is 2%.
Yeah.
What? Yeah, we've shot ourselves in the foot quite badly.
So the UK ISA is a nice gesture, but it's not nearly enough. It needs to be done. So there is.
If you did follow that through, and you were sitting in Australia and you had to buy 40% of Australian equities 10 years ago, and you missed out on all the growth in America or some of our great companies, you'd be furious. You should be allowed to invest anywhere. I mean, if you want to buy,
That's a very political.
Yeah.
well, you can't. I mean, BP's half the value of Exxon.
Yeah.
Buy
A
BP,
very similar company.
Just buy BP.
Yeah.
Well,
they've been talking about relisting in the US as well.
Yeah, just buy BP though, you'll get your answer. You just got to be patient.
Exactly.
They haven't mentioned SPACs. How many SPACs floated in America and collapsed?
Yeah, well, yeah, that was the height of low interest rates, wasn't it?
So I missed that. We got into politics again.
Sorry.
That is a very political.
There's a very politically loaded issue.
Yeah.
Just on that note, we have a webinar on July 8th, and it's going to be about election, just right after the election day. So just like an invitation to everyone to sign up, because it's going to be a really, really interesting debrief of the election day.
If I'm correct, Brexit has created this environment right now, and this is the challenge. So if we get into politics, and one would question what Labour would be doing to kind of begin to go back some way, because all we keep doing is losing our companies and losing where we are as a country. And I think that it is a challenge politically for this country right now.
It's a big, I think the interesting thing is a hot potato in all countries. So we're lucky. One of our clients is actually the CEO of Ontario Teachers Pension Scheme, which is one of the largest pension schemes on the planet. So I talk to him on a fairly regular basis. And it's coming up in Canada now. So he's had the National Lottery, he owns airports around Europe. But he's under enormous pressure from the Canadian government to invest more in Canada.
Wow. So
it's not. This is not happening. This is happening all over the world, right? There's pressure on all pension schemes to invest more locally. So this is sort of deglobalization theme, isn't it? In that we're actually going backwards road, as my mother would say. We've gone we've gone peak globalization, and now with supply chains and the Chips Act and everything else, it's all going back to more, produce locally and invest locally and blah blah blah. Yeah, which is quite interesting.
It's a regime change, isn't it?
Regime change.
Exactly.
Yeah.
Protectionism.
Yeah, protectionism is an interesting area.
Okay,
Yeah.
one more question, sorry.
No, please go ahead.
Within your, listen, I'm a dummy on all of this, but within all these portfolios, where is green technology? What should we be thinking about as far as where green is going? Same as with climate change, etc.
So
These companies that are in your portfolio, whatever. Talk a bit about
green technology. So that's an interesting one. I would say that we have nuclear.
Right.
We have a company called Prysmian, which is one of very few suppliers of high voltage cables. The investment that is required to modernise energy grids to deal with renewables is enormous. So we think that's a bit of a winner there. We hold another company called Baker Hughes, and I think they make hydrogen-powered power plants, so that's quite interesting as well. But what we would say is that we're sort of a value-oriented portfolio, so it's sort of cheap stocks. A lot of them are in quite mature industries. So there probably are some companies that might be quote-unquote a little bit less sustainable in there, but we do feel that they generate pretty attractive returns. And actually, maybe just going away from green technology, but to sort of sustainability as a whole, there are lots of industries that we've kind of taken for granted over the last 10 years. So commodities, defence, shelter, food, etc. And we've sort of been able to invest in, quote unquote sustainability. But actually, I think we've realised now in this new world that these kind of very basic commoditised industries are really important to facilitate everything else. So that's kind of where we're focusing a lot of our time, those industries that are, let's take, we don't own Anglo-American, but that's been quite a big topic recently. You might think a mining company is dirty, but without copper, there is no green technology, right? So I think it's all relative, but we have some companies in the portfolio that are kind of related to that theme, but no, I wouldn't want to suggest it's sort of very green, sustainable portfolio.
I think it's a complete nightmare area, right?
The returns are rubbish.
Well, just generally the whole area of trying to get sustainability or ESG or whatever you want to do into portfolios and what. So I listened to a program on Radio 4. The students in America are obviously being very proactive at the moment. They're saying, right, we don't want to invest in anything to do with Israel. We don't want to invest in any company that sells to Israel. We don't want any that has any dealings with Israel. Okay, so what have you got left? Not much.
Yeah.
So and if you want to invest in green technology, maybe the oil and gas companies like BP. We have a gentleman here from BP who we spoke to earlier. They've been all about recognizing their role in trying to get off fossil fuels. So it's just really hard, I think.
I think that's the irony, is that people tend to label things as a black and white. And the reality is, it'll be a company like BP, probably, that will give us the biggest bang for our buck in terms of green technology, because they've got the experience and then they've got the capital. Whereas if you're trying to invest in a startup business, it's hugely risky. We've been there in 2008. People investing in green tech and suffered terribly because
You would have done pretty well if you invested in Tesla cars in 2008, though.
Sorry again?
You would have done pretty well if you invested in Tesla cars in 2008.
Well, but that's an interesting one, isn't it? Tesla's, I don't think.
So there's I've forgotten her name now. But,
I think that's a big dilemma though, because at the moment, green technology, none of it is cost effective.
No, exactly.
So it relies on government subsidies. The big problem at the moment is countries all around the world are dealing with high level of debt. So that's the political debate. They can't afford to subsidise offshore wind, solar like they used to. So you're seeing those subsidies, disappear a lot of the time. So those industries are just not cost effective. So that's the big political debate. How much is society willing to pay for that transition, because, you know, in a capitalist society, no company is really going to get involved in these projects that just don't really have a reasonable payback. So
The
it's a big
irony,
problem.
and the irony from an ESG perspective is that all of these, like the clean energy revolution relies on things like copper and lithium, which comes from mining companies, which basically maybe on the ESG report say there's no modern slavery being used to get these ores out of Earth, but realistically they definitely do.
I mean, the whole ESG, I mean, that's a big debate anyway. I mean, that was created by the investment community anyway, as another market to make money for themselves. I don't think there's a lot behind it, to be honest.
I think that's absolutely right. I mean, we have seen now, you know, greenwashing has been a big issue, and you know, Tesla might be the ultimate greenwashing company that's ever been. You know, because they're.
No,
I know, but I mean, if you see a Tesla battery in real life, it's bloody huge, right?
Yeah.
It's, you know, and the cars weigh 2 tons. Yeah. And the amount of resources used to build I know they recycle the batteries, great, but
you know, Thunberg and jail, so it might go away.
Yeah.
Just for a second though, on this whole issue of ESG, differentiate between the investment side and what the corporates are doing. There isn't a corporate out there that isn't at least thinking about its environmental and social obligations. And in that sense, ESG is one. It started up as a movement in 2005-06. It's not about, I agree from an investment perspective, it's a joke. Why is it a joke? Because you can't aggregate environmental, social and governance issues into one score, which is typically what the data providers have tried to do on the back of that, given excuses for indices to be created on the back of which people invest a lot of money. Of course, I would say it's absurd. But the reality is, as I said, it's about what the companies are doing within those businesses to try and create new products which are more sustainable. I'm not saying there's any solutions necessarily out there. And from that perspective, the ESG movement has made a huge difference. So that's what you have to keep in perspective, the difference between what corporates are doing and actually investors are doing. And I totally agree with you. The idea there's an ESG fund, there's an ESG index, I mean, that's absolutely crazy.
Yeah, the one thing I will add to that is, all of our active managers, I believe Artemis Global Income included, integrate ESG as a whole into their investment process. They may not necessarily go for like impact themes, for example, but they will integrate it in terms of what are the potential threats or opportunities in specific sectors and adjust their valuation accordingly. So obviously, in the oil industry, for example, they will account for stuff like lack of potential buyers on the other end. So they'd have to lower their valuation targets. So although it may not be a central theme, it is fully integrated and considered in portfolios.
Well, on that note, do we call it?
Yes.
Do we call it a day?
We went over.
That doesn't mean to say you have to leave, because we're here. So we've just put some wine out on the tables. We're going to be here for a little while. If anybody wants a little tour of the club, I'm happy to do that. There is the restaurant next door if anybody wants to go and have a meal. And we hope you've enjoyed it.
No, it's been really good. Really good.
Thank you very much.